Good morning, this is Monday the 26th of October. Welcome to FreeFX. The topic of today's video is one requested from a forum member, in fact more than one, and the topic is fundamentals versus technical. I think one of the expressions used by the forum members was why fundamentals are technical and also why technicals are fundamental. So let me begin with a video topic here that really needs a lot of attention. So first of all, we have the S&P 500 here and the US dollar overlaid. Now, the reason why I've chosen these two is because although strictly we're not dealing with a currency pair, we have an example here of why fundamentals really are an essential tool when we look at the trading scenarios that we may want to take advantage of. So one of the video series that I watch regularly myself is by the chief currency strategist John Kicklighter. He is at dailyfx.com. So essentially his approach is that the market is really made of three layers. There's the technical, the fundamental, and market conditions. So when we analyze trade potentials and setups, what he does is to first of all look at technicals, and then the probability that a technical setup will actually have based on the fundamentals behind it. So the market conditions coming as a third, but also an important element. For example, in the last week there was meant to be a fairly quiet and sedate week in terms of volatility. There was a lot of movement, not just in the euro pairs because of Draghi's comments, but also because the risk scenarios associated with a large quantitative easing upgrade from the European Central Bank was spreading across other asset classes, chiefly equities and other, for example, the DAX, the German DAX, and the S&P 500, which at first may not seem related to what the European Central Bank does with its asset buying program, but that kind of shows why market condition analysis is also something that we should be aware of anyway. So that's his approach, and I very much think that there is some truth in that. And so I myself really look at, if not market conditions, I look at certainly the first two, technicals and fundamentals, on a daily basis, at least on a weekly basis for the fundamentals, because those don't really change necessarily on a daily basis, but they certainly can change from one week to another if there's a particularly high risk event and the market sort of takes a few days to react to that. Then the current can change. This particular chart really encapsulates why fundamentals are as important as technicals, and also why technicals are telling us something about market sentiment. For example, looking at this chart here, I tend to look at long-term charts because they take away the noise and because patterns over time are easier to spot. So in this example, we have 2 decades worth of data and more. And we can see, as I've mentioned in other videos, that the S&P 500, the Standard & Poor's index of US equities, has made 2 almost near exact, 2 cycles or 2 highs and lows that have occurred within 7 years of each other. The 2 highs are 7 years apart. That's the dot-com bubble, and that's the Great Financial Crisis. And now we're in sort of coming back to these levels and dropping again. We sort of doubled on that range. So we are, however, in a 7-year span again. So the level has changed, but the time span is right for a turn. And turns don't happen necessarily as a sharp sort of V shape. So we can rest assured that a monthly chart like this can help us to see in essence what the future may be. Although we don't really, we're not fortune tellers, but we certainly have to look into probability. So the probability of this turning, as you can see from the fact that it's stalled and it spent pretty much the entire year not progressing further up, means that from this run where almost every month a new high was established to a year where no new high was established tells us that in spite of this month incredible run, mostly thanks to this week's ECB stimulus upgrade promise in December. However, we don't really have the fundamentals behind it. So the fundamentals behind this, and this is where I've overlaid this other chart here in blue, the fundamentals behind this have been essentially the Federal Reserve Bank of America, that after this inverse correlation between US equities and the composite US dollar index, which essentially is obviously the dollar in relation to major currencies, the euro, pound, yen, etc. So this is a composite currency index. But even so, you can see that as a chart itself, US dollar and the S&P 500 have, in this particular version, certainly they have an inverse correlation up to this point where we have 2011, and with the introduction of quantitative easing, and from this point on we have this positive correlation where the two run almost in parallel. I say almost because there are obviously the diversions, but as a whole trend you can see that they do actually run in parallel. It's quite steep, so if we make it slightly less steep, you can see yeah, we can't make it any less. But now the point is that at some point the Federal Reserve Bank is going to upgrade its interest rate. So, or at least we're told that that is the case. As far as we know at this point in time, from the rhetoric of Fed speakers and also voters on the Federal Open Market Committee, they actually want this to happen sooner rather than later, because the countries at risk of deflation, deflationary pressures can actually come into play when the interest rates are close to zero and stagnating around near negative levels. So we have to imagine that it is going to happen. Now, when, obviously, is a big question. An October interest rate rise is put in at something like 8% on the Fed funds futures, which is really where we need to look at for a sort of forecast, and that means that we are looking possibly at December. So if that all being true, we then think up towards December, that with the Federal Reserve having done the first part of this, which is the tapering, which was much of the talk of 2014, when will the Fed start tapering? The taper, and this is really the pre-interest rate rise hype. That was the word of the day. So, but that has been done. The tightening of its asset buying program has been done, and so the next part is the raising of rates. Should this happen in December or sometime at the beginning of next year, provided that the market still believes this to be the case and doesn't sell off the US dollar in belief that actually this won't happen, or if it will happen, it's too far into the future, and it's you can only run so much on optimism and hope. So, but provided this will happen, the US dollar will pick up, and the inverse correlation between US equities and the US dollar will actually revert back to what it should be essentially, which is risky assets, if you like, or high risk buying is contrary to a hawkish US dollar. Essentially, these two should be in opposite directions. So if this were the case, the dollar would pick up and finally come past these levels in 2003, and the US equities index would revert back to basically conform with the 7-year cycle. Now we are coming to the end of the year, so the 7-year proposition really is not month specific. It's sort of between 2008 and 2015 is 7 years, but it could happen anytime. October has been historically the month of turns. You can see here and also here, I believe. So there's about half a week left to the end of October. So, but having said that, let's go back to the topic at hand, which is fundamentals. So, from a purely technical point of view, if we wanted to look at this chart and say, well, the levels that we're at, perhaps we might want to stick an RSI and say that we are oversold. Let's say that we wanted to put in an RSI, so we'll find it in here. There we go. 14 periods. Okay, so the RSI on the S&P 500 says that we are at just in the middle at the moment, but we have been overbought for 2013 and 2014, in fact quite a long time. So we come off these levels, and if we look back to where we were here for the RSI, we were at overbought levels, and we came back down and then bounced back a little bit, and then finally came all the way down to oversold. So there was a period of readjustment around here, and in this, the dot-com bubble as well, we were at overbought levels for a little while, back to the middle, and then finally broken through. So we have sort of come off the overbought levels, but we haven't quite turned below the 50 mark. So that's what needs to happen next. Now, this RSI and this chart don't really tell us what is going to happen next, and that is where fundamentals actually tell us that we are essentially going to be looking for the spark, the next big move that the markets will take as a cue to move and move fast. A move fast here is not to new highs. A move fast here would be this buy essentially is buying from a dip, temporary low here at 1,900. Okay, so what we need to be at is either surpass the 2,100. At the moment we're at 2,069, so we haven't quite really broken new highs. So we need to break new highs and actually consolidate those new highs. We need something remarkably strong, because it is very expensive to buy at these levels, so there will be very few buyers now, and certainly less buyers here than there have been at these levels when the quantitative easing sort of started establishing the 6-year run. So we really want to see that a sell-off is really where the strength would come in, and the fundamentals behind it are the Fed rate rising. That's one. Two, something that is particularly good at unnerving investors in risky positions up here, which might be coming from another country altogether, or it might be coming from an event in global markets that is a black swan event, essentially unforeseen, just like the stock market crash in back in August this year. And there it is. You can see that huge candle there. So something like that could have the potential, but with an event like that, there needs to be follow-through, and the follow-through hasn't quite happened, but it certainly was a first shock to the system. But on a monthly chart, you can see how long it takes for a run that goes on for years to turn. It takes 6, 7, 8 months, even a year. So we have been here at these levels 1, 2, 3, 4, 5, 6, 7 months, 8, 9 months. Okay, so let's say 9 months. If this is to happen within the end of the year, then certainly there could be a number of reasons why it could happen by the end of the year for consolidating profits and really just covering, or it could be that there's an event in world markets, or some excuse, some reason to sell off and get out quickly and save profits. We don't know what that is, but certainly marrying technical and fundamentals is very important for that reason, that fundamentals are what drives the market, and technicals are what helps us positioning, but technicals and lines on a chart do not drive the markets. So that's just a basic introduction to the two issues and why they are interrelated, and I will do probably another video on this, but good luck trading.